Stocks and the dollar moving to the upside today, looking to recover from Monday's rout. The currency, usually considered a safe haven asset, sank to 3-year lows as the so-called Sell America trade intensified. Given the volatility, where can investors find opportunity outside of the U.S.? Joining us on that, Paul Eitelman, Russell Investments Chief Investment Strategist for North America. Paul, great to speak with you this morning. It's been interesting to watch the flows because we have seen outflows from the United States, inflows to international equities. Where do you continue to see opportunity in terms of international exposure that's not already starting to be a little bit overdone?
Yeah, I mean, global diversification has been a big focus for us in 2025. And so I'd say two regions that stand out as being attractive here, in our view, are Europe and Japan. I think in the case of Europe, it's certainly been a performer year to date relative to the United States. But even with that outperformance, relative valuations on a forward price to earnings basis are trading at still a 30% discount to the US market. That's about as cheap as Europe has been since 2001. And I think we've started to see some incremental cyclical catalysts for European fundamentals here as well. Obviously, the ECB has been cutting interest rates, which is a positive. There's been increased fiscal spending from Germany. We're starting to see a credit impulse creep in through the banking system in Europe, which correlates pretty nicely with GDP growth. And that combination or recipe of cheaper valuations and improving cyclical dynamics is often a positive one for investors. I mentioned Japan as well. I think that's another area where, on the back of corporate governance reform, we're starting to see better usage of cash from Japanese corporates towards buybacks, improving margins, improving return on equity. And Kenny was talking about a potential trade deal with India earlier. I'd say Japan's also towards the front of the pack, towards a possible trade deal with the United States in the coming days. And if we get a positive there, that could be a kicker for both Japanese equity market performance, but also global equities at large if we start to hit some of those singles that Kenny was talking about and start to improve risk appetite in the market again.
And also just curious how you're thinking about declines in the U.S. dollar, currently on track for its worst month since 2009. How does that frame your investment decisions, particularly when you do look at asset classes that might be impacted by those currency moves?
Yeah, I mean, as a U.S. investor, that obviously improves your all-in dollar returns for non-U.S. equity market exposure. So it's a consideration. We've seen pretty unusual dynamics in the dollar recently, a bit stronger today, but I think some question marks around U.S. exceptionalism and the soundness of U.S. institutions after the attacks on the Federal Reserve yesterday that have just, raised some questions around the U.S. over the short term. But again, if we can start to change this tone, no news is good news around attacks on Fed independence today. If we start to get some trade deals as well and improve the tone on trade policy, I think you could see some stabilization in dollar dynamics, and again, that broader risk appetite for global markets.
And Paul, my guest host Kenny has a question for you. Kenny?
Hey, Paul, how are you? Good morning. Let me ask you a question. Just like when the dollar is strong and it rises and we come to earnings season, everyone gets concerned because that the whole dollar and they transfer farm profits back, then it's less money and blah, blah, blah. The reverse is true. As the dollar is weaker and U.S. large multinationals transfer those profits back, it's actually a benefit to them, correct?
Yep.
And so what do you see? So that will take some of the sting out, I think, in terms of all this nervousness, because having a weaker dollar certainly benefits them. What's your view on that?
Yeah, absolutely. That's a big dynamic for multinationals if you're thinking about the outlook for S&P 500 earnings over the coming quarters. Roughly speaking, every 10 percentage points of weakness in the trade-weighted dollar would map onto a boost of, call it, 1 to 2 percentage points for S&P 500 earnings growth. So there's a lot of push and pull here, some potential headwinds from trade policy, some potential offsetting positives from the dollar. I'd say on balance, our expectation is that corporate earnings growth is likely to moderate from very strong run rates at the end of 2024. But I think as long as we can avoid a recession, which at the margin is our base case here, that's an environment where S&P or earnings growth can probably deliver, call it mid-single digit positive results, which I think would be rewarded into this market after the significant sell-off that we've already seen year to date.
Right. I think that's exactly true. Let me ask you one more question based on kind of your conversation with Madison when you came in. Given this environment, are you suggesting that the investors should now overweigh their exposure to the foreign markets? Or because typically for me, when I think about foreign markets, I think about 10% of the portfolio should be in foreign markets. Are you suggesting in this environment that people might want to raise their weighting in their foreign exposure?
Yeah, I think there's two layers to that conversation. Number one, we do think that strategic global exposure is really important from a diversification perspective, and that's certainly been a theme and feature of the market so far in 2025. And I'd say at the edges, a modest overweight to areas like Europe and Japan could be appropriate, and that's a theme that's a part of some of our global equity strategies here.
Really quickly, Paul, when you think about barbelling strategies, do you barbell using U.S. Treasuries in this moment or cash?
Well, I think the front end of the curve is looking most attractive to us in terms of valuation. It's still a pretty shallow and flat curve from a historical perspective, and you're getting that safe yield in an environment where tariffs directionally could be stagflationary. I think they would protect portfolios in a recession scenario, but those inflation consequences could possibly challenge the long end and would make points of the curve like the 2-year point or the cash potentially a little bit more attractive for that sort of diversification and ballast.
All right, Paul, got to leave it there. Thanks so much. Appreciate it.